Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Monetary Policy and Central Banks. Monetary policy and central banks play paramount roles in the economic stability and growth of nations. Central banks, such as the Federal Reserve in the United States and the European Central Bank in Europe, are pivotal in crafting and executing monetary policies aimed at controlling inflation, managing unemployment, and fostering overall economic stability. These institutions utilize a variety of tools and strategies to influence money supply and interest rates, thereby impacting economic activity in profound ways. Monetary policy can be broadly categorized into two types: expansionary and contractionary. Expansionary monetary policy is typically employed during periods of economic downturns to stimulate growth. This involves lowering interest rates and increasing the money supply. Lower interest rates make borrowing cheaper for businesses and consumers, encouraging spending and investment. For example, during the 2008 financial crisis, the Federal Reserve slashed interest rates to near zero and implemented quantitative easing programs to infuse liquidity into the economy. Quantitative easing involves the purchase of long-term securities, which increases the money supply and lowers long-term interest rates, further promoting economic activity. Conversely, contractionary monetary policy is utilized to cool down an overheating economy and control inflation. This policy involves raising interest rates and reducing the money supply. Higher interest rates make borrowing more expensive, which dampens spending and investment, thereby slowing down economic activity. A historical example is the early 1980s when the Federal Reserve, under Chairman Paul Volcker, raised interest rates sharply to combat double-digit inflation. This policy successfully reduced inflation but also led to a significant recession. The effectiveness of monetary policy is heavily influenced by the expectations and behavior of economic agents. If businesses and consumers expect inflation to rise, they are likely to adjust their behavior in ways that can actually bring about higher inflation. Central banks, therefore, place significant emphasis on managing expectations through forward guidance. This involves communicating future policy intentions to the public in a clear and transparent manner. For instance, the Federal Reserve's regular press conferences and reports aim to provide insights into its future policy direction, thereby shaping expectations and economic behavior. Another critical aspect of monetary policy is its impact on exchange rates and international trade. Changes in interest rates can lead to fluctuations in a country's currency value. When a central bank raises interest rates, it often attracts foreign capital seeking higher returns, leading to an appreciation of the currency. Conversely, lowering interest rates can lead to a depreciation of the currency. These exchange rate movements can significantly affect a country's trade balance by making exports more or less competitive on the global market. For example, the aggressive monetary easing by the Bank of Japan in recent years has led to a depreciation of the yen, boosting Japanese exports. Central banks also play a crucial role in maintaining financial stability. They act as lenders of last resort, providing liquidity to financial institutions in times of crisis to prevent systemic collapses. The 2008 financial crisis highlighted the importance of this function. Central banks around the world, particularly the Federal Reserve and the European Central Bank, took extraordinary measures to stabilize the financial system by providing emergency funding to banks and other financial institutions. Moreover, central banks are responsible for regulating and supervising the banking sector to ensure its soundness and resilience. This involves setting capital requirements, conducting stress tests, and monitoring the risk-taking behavior of financial institutions. The aim is to prevent excessive risk-taking that could lead to financial instability. For instance, the Basel III framework introduced post-2008 crisis has significantly strengthened capital and liquidity requirements for banks, enhancing their ability to withstand financial shocks. In summary, monetary policy and central banks are indispensable in shaping the economic landscape. Through the use of various tools and strategies, central banks manage money supply and interest rates to achieve macroeconomic objectives, such as controlling inflation, managing unemployment, and fostering economic stability. The effectiveness of monetary policy hinges on the expectations and behavior of economic agents, making forward guidance a critical component of policy implementation. Additionally, central banks' influence on exchange rates and international trade underscores their global economic significance. Furthermore, their role in maintaining financial stability and regulating the banking sector is crucial in preventing systemic risks and ensuring economic resilience. The intricate interplay of these functions underscores the complexity and importance of monetary policy in the broader context of public policy economics. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.